Welcome to this Back to Basics accounting video, where I will discuss the infamous accounting equation. Whenever you start with your accounting studies, you will always hear your teacher or lecturer talk about the accounting equation, drilling it into your head, and rightly so. The equation is fundamental to accounting. I will highlight the fundamentals of the equation and with some simple examples, demonstrate how it is applied to various transactions. So accounting, and I'm sure you already know this, is the process of recording the financial information of a business. Accounting and reporting standards require that businesses record their financial information in a standardized way. And this resulted in 5 basic account types, which are asset accounts, which are items that bring value to the business, equity accounts, such as owner's equity and shareholders' equity. These accounts consist of funds invested into the business and drawings, as well as profits and loss generated by the company. Then you also have liability accounts. These are amounts the company owed to other stakeholders. You also get income accounts. These accounts consist of income earned by the business. And expense accounts, showing the cost of running the business. The 5 basic account types are important because they appear and are presented on the face of the financial statements. Assets, liabilities, and equity accounts will appear on the statement of financial position, also known as the balance sheet. And the income and expense accounts appear on the statement of comprehensive income, also known as the income statement. The reason I briefly touched on the basic account types are because these accounts are related to each other, and the accounting equation shows the relationship between them. If you need to freshen up on the basic account types and common accounts used, then watch the video on basic account types on this channel. So let's talk about the accounting equation. In its simplest form, the equation is assets equals owner's equity plus liabilities. Owner's equity, also called capital, depending on the business form you're reporting on. The accounting equation is based on the principle that everything the company owns, in other words, its assets, is owned to or funded by either the owners in the form of owner's equity or creditors, your liabilities. Using T accounts, we can demonstrate the impact on the equation where assets increase on the debit side and a decrease on the credit side. Owner's equity or capital will decrease on the debit side and increase on the credit side. And liabilities also decrease on the debit side and increase on the credit side. 2 interesting points to notice regarding the accounting equation. 1, it reflects the format of the statement of financial position, where assets are presented first and the total assets amount balanced to the total amount of equity and liabilities. And number 2, it reflects the fact that total debits must always equal total credits, forming the foundation of double entry accounting. The equation can also be expressed as liabilities equals assets minus owner's equity or capital, or owner's equity equals assets minus liabilities. We have now shown how the accounting equation is used to show how transactions affect 3 out of the 5 basic account types, namely assets, liabilities, and owner's equity. But what about income and expenses? Income and expenses relate to the entity's financial performance, and it will ultimately result in profit or loss for the period. Thus, owner's equity or capital includes funds invested by the owners, less drawings, plus profits, less losses. So the accounting equation can be expanded to incorporate the impact of drawings and profits. In other words, income less expenses. Then the accounting equation will be assets equals capital introduced plus income less expenses less drawings plus liabilities. Let us consider a practical example of the application of the accounting equation. Here you will recognize the accounting equation with each aspect of the equation in its own column. Here I will demonstrate the impact of each transaction on the equation. Debit values will be shown as positive values and credit values will be shown in brackets. So let's work through the example. Explain how each of the transactions below impact the accounting equation. 1. Paul started a business with $3,000 cash. 2. He personally also purchased a computer and a printer for the business for $1,500. 3. He received a business loan from the bank for $15,000. 4. He paid $1,500 cash for advertising his business. 5. He purchased inventory for $8,000 cash, which was 40 units at $200 each. And 6. He sold 10 units of inventory on credit to a customer for $2,500. So number 1. Paul started a business with $3,000 cash, which means he took his own personal money and he invested it into the business. He introduced capital into the business. And we know that owner's equity increased on the credit side. So I'm putting a credit value of $3,000 under capital introduced. And our assets increase because it's cash that we received. And that increases on the debit side. Number 2, he personally also purchased a computer and a printer for the business for $1,500. Again, computer equipment and printers are assets to the company and it increases on the debit side. But it again was done with Paul's own money. So he again introduced, he invested into the business. So our capital introduced again increases with a credit value of $1,500. Number 3, he received a business loan from the bank for $15,000. So here, the business received $15,000 cash, which is an asset, and it increases with a debit value of $15,000. But at the same time, this is now a loan from the bank, in other words, a liability to the company, which will have to be repaid. So liabilities increase with a credit value of $15,000. Number 4, he paid $1,500 cash for advertising his business. So here it was money out. In other words, our cash reduced. So our assets reduced with $1,500, a credit amount. He spent the money on advertising. So our expenses increased on the debit side with a positive value of $1,500. Number 5, he purchased inventory for $8,000 cash, which was 40 units at $200 each. In this case, again, he spent money, so our cash reduced with $8,000 credit value. But he received inventory to the value of $8,000. And inventory is an asset to the company, so assets also increased with $8,000. So from this example, you can see that the overall net effect on assets was 0. But if you look at the individual asset classes, you will note that cash decreased and inventory increased. And the last transaction, number 6, he sold 10 units of inventory on credit to a customer for $2,500. So with this transaction, we need to be careful because there's 2 parts to it. 1, the sale that took place, and number 2, the inventory that reduced because of the sale. And we need to account for both. So let's focus on the first part, the sale that took place on credit to the customer for $2,500. We know that sales is income to the business. Income is part of owner's equity. So we increase income with a credit value of $2,500. But it was sold to the customer on credit, so we did not receive cash, but this customer now owes the company money, and it's part of our debtors control, our accounts receivable, which is an asset to the company, and that increased by $2,500. The second part of the transaction is the units of inventory that was sold. There's a reason why under point number 5, they show you in brackets that it was 40 units at $200 each. And there's a reason why they tell you then in number 6, the amount of units that were sold, which was 10. Because here you need to do a bit of a calculation before we can continue. We first need to work out the cost of the inventory sold. So we know from point number 5 that a unit costs $200. And the cost of the units sold would then be 10 units at $200 each. The cost price of a unit, not the selling price, the cost price. So 10 multiplied by 200 each is $2,000. So in this case, the cost of the inventory sold is $2,000. So we now know that inventory reduced with the 10 units that was sold. So inventory being an asset means that our assets reduced by $2,000. So I'll input a credit amount of $2,000 in the asset column. And then the cost of the inventory that was sold is a cost, it's an expense to the company. So our expenses increase on the debit side with a debit value of $2,000. That will reduce our inventory with $2,000 and it increases our expenses with $2,000. So if we now calculate the total of each of the columns, we will note that the assets equate to a debit value of $18,500 and the sum of the total equity and liabilities equate to a credit value of $18,500. From the example, you can see that the accounting equation will always balance because of the double entry principle, where each transaction has a debit and a credit of equal value. So there you have it, short and simple. Subscribe for more Back to Basic videos and feel free to like and share these with anyone who might benefit from it. And if you have any questions or you would like to see a video on a specific topic not yet uploaded, just drop me a comment below. Also, if you would like printable clips of this video, where you can make your own notes or something like that, just ask. I don't mind sharing.